Devang Mehta, good afternoon.
Nikunj, thanks for having me on the show.
What are you telling your clients to do? Bat on the back foot or front foot?
I think that's a good question. Probably my sense is that front foot will serve you a little more purpose than playing on the back foot. And why I say that, because yes, market will definitely take some pause after such a huge rally that we saw since March. It was virtually a rally, one-sided rally. There had to be some gravity, Nikunj, to the proceedings, and that has come. Be any the reason can be. The excuse can be any sort of a reason, be it US yields, be it inflation still not under control, the narrative on interest rates and inflation. But more importantly for India, I think revisiting the earnings season, which just got over, say, 7, 8, 10 days back, I think that objectively, a lot of analysts and a lot of people like us are going back to the drawing table and looking at the earnings picture, looking at the P-re-rating had already happened, whether there is sound earnings which has come in, whether the earnings are in line, what the management has commented over the near future, and what the festive demand as well as in India, macros are absolutely not a big problem, unlike the other parts of the economy which we were talking about earlier. So my sense is that one has to probably bet on front foot. Yes, there can be an approach where you stagger out your investments over the next 2-3 months, but you have to be always on the lookout for those sectoral and thematic ideas.
Okay, when Kunal and everybody thought, Nuresh didn't think like this. Kunal, you only thought like that. Markets have recovered. See Nifty in the green.
Bank Nifty is 48 negative now.
And Nifty is recovered, like 2 points up. 2 points up from when we discovered last. Nuresh, what's going on in your assessment?
So, see, we look at Nifty, but if you look at the weightages, even in the Bank Nifty, HDFC Bank and ICICI Bank both are silent. It's not, HDFC Bank has been for quite some time. But if you pick up the chart for ICICI Bank for the last few days, all you see is plus minus 5-10 points from that 950 mark. So if you don't have a trend in any of the stocks, this plus minus 50 points flips in the day is something which we just cannot regard. So the only thing which comes down to the fact that nothing is happening on the negative side on the broader market. We are continuing to see stock specific move. So it's just the time to wait. Markets tend to consolidate, and this is that sort of a consolidation where it's just not going anywhere. So a lot of stocks are just at the same places.
And it's quite intriguing because, the rest of the globe has had actually a good day. So I was just looking at the Asia rates. Japan recovered about 1%. Korea, Hong Kong saw a move of 1%. And even Shanghai finally, after a quiet start, picked up in the green and managed to close nearly with a 1% gain. Europe has started off on a very strong footing as well. Some of the, earnings have been very, very strong there. So DAX, FTSE, CAC. In fact, CAC is now up over 1%. Even the broader index like a FTSE MIB, Stock 600, they're seeing some phenomenal moves there. But our markets are quiet as they may be. And I think the key is, like Kunal was highlighting, look at what's happening within the individual banking names, because there's a sudden drop in the last few odd minutes or so. If you look at HDFC Bank, that's now fallen 0.5%, and you can see the drop came in just the last few minutes. Similar is the price action for an ICICI Bank as well, that steep drop. SBI, of course, was an underperforming stock from the word go, but right up pretty much at the session lows, 0.5% of a downtick coming in there too. And yes, similar is the price action pretty much across the banking pack. Naresh, what do you do with the Nifty Bank?
So as of now, the view is bullish. We keep the stop losses at the recent low on the Nifty and the Bank Nifty. We are seeing a reversal in the global markets as well. None of the risk parameters across the globe are turning around. So as of now, it's a stop loss below 43,500, accumulate the dips and be long same way. 19,250 is a stop loss for the Nifty as well. So positive on it, but more focused is if one has to look at it, better is to go with stocks. There are stocks breaking out. There is a federal bank nearing a breakout. There is a RBL bank which still looks strong. IndusInd. So you're seeing the smaller banks doing well. Even the small cap PSU banks have done better than the large cap ones. So the view is positive. Add more on the way up about 44,200, 300 levels.
OMC is to provide additional incentive of 3.7 litre on ethanol produced from damaged food grain and maize. Now, what does that mean? Let me try and break it up. when the ethanol policy was announced, ethanol policy had two basic pillars. One, that government, and in this case OMCs, they will buy from ethanol producers at a set price, and that would be a multi-year contract, and they would be supplied with raw material, in this case which is damaged food grain or food grain, at a subsidized price. Then comes the big inflation in wheat and then also in rice, and then suddenly the government came out with a directive that ethanol production in India will have to be done where the ethanol producers will have to buy them from the open market. Then of course ethanol producers were losing money, they went back to the government, and now another incentive has kicked in that OMCs will provide additional incentive of 3.7 lakh to ethanol produced from damaged goods. Not too many companies are there. I think there is Gulshan Poly, Praj indirectly would be there. I think there's Bhatinda Chemicals. A couple of very small names are there in terms of what companies would do. But Praj is an indirect machinery beneficiary. Gulshan is in this business, and I think Bhatinda Refinery or Bhatinda Chemicals, one of those, they are also in the same business per se. The spikes I think are there, but again these are very illiquid names. Meanwhile, this is bad news for OMCs. Why? Because if food grain prices go up, they are subsidizing. If oil prices go up, they have to be subsidizing, which means for the rest of the whole time, they're only subsidizing.
They're always compensating, yeah, and you can see quite a sharp reaction. Of course, this is source-based news. Maybe we should get in our reporters and try and do a link as well and find out more details on, when could this move be applicable. But let me quickly take it across to Sharad and find out what the buzz across the dealing rooms are. And what are the stocks, Sharad, that's on everyone's radar this afternoon?
Well, yes, we have been speaking with dealers, and in focus we are having Engineers India, and looking at the stock, the volumes have been very strong, coming at almost 3 times its 20-day average, and the dealers have said that in certain counters HNI buying is still being seen. Now do remember the stock is at its 5-year high levels, and that is something to watch out for. But do remember the important triggers going ahead for the stocks is especially expected that a major oil and gas order would be coming in for the stock, and also the company recently won a large order coming in from the ONGC segment, and the company will be also focusing on the new age segment, and this includes the names of biomass, hydrogen and biofuel. So that is what the street is actually bullish on, and even the brokerages have recently given upgrades to the stock, and they have also stated that the company itself is having a strong order book, especially coming from the petrochemical segment.
Okay. Devang, which is your favorite PSU stock? I never thought, a couple of years ago that I would ask any guest that do you like anything in PSU, but right now that is the most common question. So which is your favorite PSU stock minus banks?
So ideally, to be very fair, not considering many of the PSUs as a buy candidate right now. Yes, you are right. Most of this had a dream run. Companies like REC, PFC, of course, I'll not suggest it as a buy or a recommendation. But these are some companies which had deep value inside them. There was a dividend yield play at work. There was energy efficiency which was going to be established in India, and the SEB's problem was probably going to be solved. Of course, taking the liberty of talking about bank, which you said, I can't. But yes, something like an SBI probably. Again, as I said, not a recommendation, but State Bank, seeing the turnaround that all these banks had. And yes, we are going to go through a big capex cycle, big consumption boom, and what better proxy play than top large private banks and a couple of PSU banks. I think that is where a pure next 2-3 year a little bit of value and a little bit of growth also lies. Otherwise, yes, most of this defense stocks, most of these companies which are into defense arena, as well as these companies into railways, they seem to have a good time. So railway capex has been almost multifold over the last 3-4 years. That has increased so much that something to do with railway capex. Yes, one probably can look at it. The way these trains are revolutionized, way the electrification has been done, signal systems. I think most of these themes have been played. But yes, there can be certain decent candidates over there.
Okay, let's just address a piece of news that we were just highlighting, the fact that OMCs may be providing an additional incentive of 3.71 rupees per litre on ethanol produced from damaged food grain and maize. In fact, Somit, who's actually picking up this buzz, joins in for more on that. Somit, what is it that you're picking up from your sources?
Well, this announcement is coming in beneficial for companies like BCL Industries, Gulshan Polyols and Global Spirits. Now, what oil marketing companies are doing is that announced an additional incentive of 3.7 rupees per litre or ethanol produced from damaged food grains and maize. Now, with this additional incentive, the total incentive that they will be giving for ethanol produced from damaged food grain would be around 8.46 rupees per litre, and on maize it has been increased to 9.72, and both these rates will be applicable from the 7th of August. Now, with this additional incentives, oil marketing companies are now expecting their vendors to provide the maximum possible ethanol to them to achieve the ethanol blending target. Now, the blending target is at around 25%, and as of July 2023, the companies had a blending of around 11.9%. Now, if you remember, on 7th of August, the first additional incentive was provided of around 4.7 rupees on damaged food grains, and on maize it was around 6.01 rupees. And today, additional incentive has been announced, which will be applicable again from 7th of August. Now, because of this additional incentive, the financials of these companies would again be profitable. Now, earlier there was supposed to be losses for these companies because of the increase in prices of damaged food grains and maize, and that was because FCI had suddenly halted additional surplus, had halted providing surplus rice to and additional food grains to these companies to produce ethanol. Now, given that additional incentives are coming in, the financials of these companies would again be profitable on the back of these incentives that they will be getting.
Right. Okay, that's the word coming in on what exclusive sources are now telling us and how it's impacting OMCs. In the meantime, Devang, before we let you go, just wanted to understand, what is the house call right now? What are your biggest overweights and underweights in the market?
Aisha, I think the biggest positive that we draw out from all this is that capex has come back for sure, be it government capex and of course followed by private capex. Importantly, sectors like BFSI, which are beneficiaries of not only capex but also consumption and credit growth, is one of the favorite sectors to be in. Yes, I know it's a crowded trade, but banks had a good round of correction and consolidation in the past couple of months. I think that is one sector to go to. Second is clearly auto, which has come up with good set of numbers. Not only the margins have expanded, but the demand scenario as the festive season comes in also is a good medium term type of an investment opportunity. Auto as well as auto components, and followed by something in capital goods and cement. I think this sector as a overall, be it building material, be it cement, be it capital goods, this sector probably is in sort of a next 3 to 4 year type of a structural bull run, where be it paints, be it adhesives, be it cement, most of these companies will come back to the fore, and the demand probably as well in the large cap, mid cap and the small cap space as well. Most of these companies will tend to become either emerging market leaders or market leaders.
Well, I just want to go back to a very simple question, Devang. Everybody likes banks, right? It's a sector which is growing. It's a space where problem is not there. But in this year, when we've had a grand comeback in the markets, FIs are back, domestic investors are back, mid-cap index is at an all-time high. The bank Nifty for the year is flat. Why is that?
Yeah, I think Nikunj, a very good question, very relevant question in the current setup. See, what we have seen over the last 6-9 months, and particularly this year, to be very precise, 7-8 months of calendar year and 6-7 months of financial year. I think it's clearly more a sector rotation which we have seen. Right, and earlier IT used to do well, and then followed by banks, and then suddenly cyclicals came to the fore. Domestic cyclicals also started to do well. So I have not seen a sort of a rally wherein all the sectors out of your Nifty has done well. Though the broader markets would have probably performed very well, as you rightly said, mid-cap index at a life high, small cap just kissing distance away from that. Most of these companies in the broader universe have done very well. I think value lies outside of Nifty as well. There are many companies in the next Nifty or even below that in BSE 200 where I think there is a lot of value emerging. So you're right saying that probably this in the last 6-7 months, Nifty, bank Nifty would have been flat. But yes, you need to buy into businesses which have not sometimes done well over the last 6 months, 2-3 quarters. It had ahead of expectations, and I see this more as an opportunity in adversity, in terms of adversity in prices, not even in terms of macros or micros. So numbers were good. Most of these companies are enjoying the fruits of credit growth. Yes, probably they were a little ahead of in terms of value creation. My sense is that this is a good opportunity in adversity to buy some sectors which are underperforming, just as a sector rotation and hibernation takes over.